I'm Alan Kenny, and we're in New York for REIT Week 2017, Nareit's Investor Forum. I'm joined by Rick Romano, Managing Director and Portfolio Manager with PGIM Real Estate. So Rick, so far 2017, what has been the biggest story to you in the real estate markets?
There's been a few stories. I would say, number one, interest rates. We're not at levels that I think people thought we were going to be at when we began the year. So if you look at what happened after the election, there was a big focus on reflation and rates going up. As we moved into the course of the year, and some of the policy initiatives seemed to be, at best maybe pushed back, at worst certainly watered down and pushed back and maybe not be able to get done, things like taxes, infrastructure. I think that has reset expectations on growth rates, reset expectations on interest rates. The other thing I would add is that I think active management this year within REITs is doing a lot better than last year. So last year you had a situation where yield mattered, and that was the only thing that mattered. So it didn't matter if companies had good quality real estate, good balance sheets, good cash flow growth. All that mattered was the best yielding names did the best. So this year that's changing, and that's a better environment for active real estate managers.
And then how about looking at the international markets? Are there any that are particularly intriguing to you right now?
Sure. So we look at evaluation-based metrics, and when we look at it that way, Japanese developers are screening very strong. So when we look at their price versus real estate value, probably the lowest it's been towards the low end of where it's been in history. Now, that can be volatile because those companies tend to trade sometimes on macro events. What is the Bank of Japan doing? What does monetary policy look like? How are they intervening into the public markets, particularly the J-REITs? So we do like them, but we do manage risk by how we measure our active share for those names. The other areas that we like are in Europe. So if you look year to date today, non-U.S. companies have outperformed U.S. companies in the REIT space pretty significantly. We do like Ireland and Sweden at this point, and they offer the best value, we think, in terms of strong fundamentals still, good strong rent growth still, and then good valuation levels at this point still.
And then looking ahead to the next 6 months, what do you recommend that real estate investors track?
So I think for the first time in a while, we're going to have to really pay attention to government policy in the U.S., how quickly it gets implemented, what gets implemented. There's tax legislation that's out there. There's legislation specific to real estate around depreciation and 1031 exchanges. So we need to keep an eye on that. Also, I think we still need to monitor the interest rate environment. How is that tracking as we get further into the year? And then the third thing would be retail. We've seen the retail wreck this year. I think real estate investors are very good at underwriting cyclical risk and pricing cyclical risk. Retail is looking a bit more secular in terms of the risks, and that becomes a bit more challenging to price and underwrite. So what will rents look like over a 5-year hold or a 10-year hold? What will cash flow growth look like? What does asset pricing look like? So I think the industry is struggling with that right now. That will tend to settle out eventually, but I think there's a lack of transparency as to where that is right now, making the asset class fairly risky for most investors right now.
Rick, thanks so much for your time.
Thank you.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.